Hi, how's it going everyone? My name is Hank and welcome back to the channel. So today we're going to be talking about a very big and important topic, which is the topic of recession. Now, we want to go over what exactly is a recession and how do we get into a recession and what's the relationship between inflation and recession and how long does a typical recession last? And how do we get out of a recession? And finally, what happens to stock prices, bond prices, or even house prices during a recession? So according to Investopedia, a recession is defined as 2 consecutive quarters of economic decline as reflected by GDP, along with other indicators such as a rise in unemployment. Now, a recession is a broad decline in the market over an extended period of time, and not just a decline in profits of a few major companies. So, is New Zealand in a recession? No, we are not. So, the economy actually expanded by 3% in New Zealand in the previous quarter, after a drop by 3.7% for the previous quarter. So, we need another 2 quarters of GDP drop for it to be a recession like what we had at the start of the pandemic. On the other hand, the US is not so lucky. They had a drop of 1.5% in terms of GDP in the previous quarter. So it could very well be the beginning of a recession. Now, in fact, there are economists in the States that have predicted there might be a recession coming within the next 12 months in the States. So what's all this talk about inflation and recession, and how does those two relate to one another? So inflation is the increase in the price of consumer goods, and what the Reserve Bank tends to do to combat this is to increase the interest rates. So inflation is the increase of the price of the consumer goods. And what the Reserve Bank tends to do to combat this is to increase the interest rates. This serves to drive down consumer demand so that people don't take out as many loans so that the prices don't keep on increasing. But what tends to happen is that people just hold on to their cash and not spend it, thus driving the economy into recession because nobody wants to buy anything or spend extra money. Now, remember, we are not currently in a recession, but there's always the possibility of going into a recession if interest rates keep on rising. Now, the modern money theory suggests that recessions tend to occur once every 10 years or so. Now, before the pandemic-induced recession in 2020, we've gone around 12 years without a recession. And that recession that we had was particularly short, lasting less than 6 months before everything bounced back. Typically, a recession tends to last between 8 and 18 months. Now, you might think that, oh, that's quite a long time, but that is reasonably short compared to the decade-long period of growth that we tend to get in between the recessions. So how does a recession affect stock prices? So typically, stock prices tend to go down as people start to curb their spendings and companies don't earn as much profit. Now, many people also choose to sell their stocks and move them into safer investments such as bonds or cash. Stock prices tend to be a leading indicator of recession, which means that stock analysts are forward-looking to predict the prices of the companies, and if they anticipate that a recession is coming, they tend to drop the expected prices of stocks before the recession actually hits. So stock prices tend to drop before a recession is officially hit, and they also tend to start bouncing back before a recession is officially over. So what happened to bond prices then? Bond prices tend to increase because people are looking for safer investments, so they sell stocks and they tend to buy more bonds. And also remember, if we are in an actual recession, like during 2020, the Reserve Bank tends to decrease the interest rate. The Reserve Bank tends to decrease interest rates to stimulate the economy, and a lower interest rate usually results in higher bond prices. Now, the final point that I learned is a real interesting one. So what happened to housing prices during a recession? House prices tend to go up during a recession. Now, this might be interesting because people probably would expect house prices to go down during a recession. But remember, the Reserve Bank tends to lower interest rates as a response to a recession. And this would encourage people to take out loans. And because during a recession, people tend to move away from stocks, many of them would like to put money into what's perceived as a safer investment, which are quite often houses or real estate. Historic data tend to support this theory since the biggest gains in house prices tend to coincide within a bear market. This has proven to be true as we have seen some of the largest increases in house prices during the recession that we had in 2020. Ultimately, the question is, are we heading into a recession? So the simple answer is yes. Now, this is just because the market simply cannot continue on growing indefinitely. An occasional recession is almost what's required for a healthy market. So what we need to do is to not fear that a recession is coming, but to properly diversify your portfolio and maintain some cash or emergency fund so that you can safely navigate through these downturns. And maybe perhaps pick up some assets on the cheap when the opportunity presents itself. Thanks for watching.